Hello, everyone, and welcome to today's webinar on the rewards and perils of mean reversion trading. My name is Aditya Gupta, and I will be your host for the event. Now, I'm pleased to introduce our distinguished speaker, Dr. Ernest Chan. Dr. Chan is the founder and CEO of PredictNow.ai and a managing member of QTS Capital Management, LLC. Before joining the financial industry, he received his PhD in physics from Cornell University and was a member of IBM's Human Language Technologies group. In this session, Dr. Chan will discuss how their fund, QTS Capital Management, benefited and suffered from trading a mean reversion strategy and what they did to mitigate the tail risks. So without any further ado, I'd like to kick things off by welcoming our speaker, Dr. Ernest P. Chan. Dr. Chan, over to you.
Thank you very much, Aditya. It's my honor to be invited. Yes, once again, thank you, Aditya and your colleagues at Quantitative for inviting me to this, most happy occasion for the 10th anniversary. I've been, with Quantitative since the beginning, and I have been, extremely impressed by their work so far. So I'm very honored to be invited to give a webinar today. So as I did mention, I'm going to talk about mean reversion strategy, which is what I have talked about a lot in my books. Nothing in theory compares to what we actually experience in live trading, right? So you can read all you can about mean reversion trading, but seldom do you hear the real life experience of trading a mean reversion strategy on millions of dollars and how that feel and what that encounter. And that my talk is about that journey. So as the intro said, we ran a fund, QTS Partners LP, since 2011. In the beginning, which was 9 years ago, not quite 10-year anniversary. In the beginning, we had only one strategy, which is a spot forex strategy, and this is a mean reversion strategy. And it trade only one pair of currencies. We just rely on one pair of currency in order to manage the fund. It is a bit amazing, actually, thinking about it. We like simplicity, as I have also expressed in my book. We like simple things. So one pair of currency that did well is better than 10 pair of currency that didn't do well. With this one pair of currency, it is however, a fairly high frequency strategy. It is essentially a market making strategy between these two currency pairs. And market making strategies are, usually mean reverting. We don't, because for momentum strategy, you have to use market orders. You are not making market. You are taking liquidity from the market. Whereas for mean reversion strategy, you are the market maker effectively, and you are providing liquidity to the market. And most of the market making strategy occur at fairly high frequency because liquidity demand come and go very quickly. And that's what we try to do in this spot forex strategy. And you can see in the first 6 months of trading this strategy, we barely had a losing day. We had amazing returns and very consistent returns. Sometimes I observe sitting in front of a computer. I mean, it's fully automated trading because it's it's fairly high frequency. We can finish a round trip profitably in 30 seconds. Sometimes it took longer, but sometimes it takes very short time. And so that's was amazing to us. And we thought that we can probably make millions of dollars launching a fund just trading this one strategy pair. And so here is again the return in graphical manner. As you can see, very nice smooth curve in the first 6 months of trading. Well, actually 7 months. So we leveraged this strategy 14 times. Success got into our head, right? If you have barely a losing day, why not leverage it as high as you could? Even if you are going to apply Kelly formula, right? Even if you are of a quantitative mindset, and you apply Kelly formula, or even half Kelly, you apply half Kelly leverage based on this amazing realized Sharpe ratio of the 6 months. Even half Kelly would have advised you to leverage 14 times. Of course, Kelly formula is based on a Gaussian distribution of returns. It's assume a Gaussian distribution of returns, and we shall soon find out. We soon found out that the returns of this strategy is hardly Gaussian. So what happened next? You can see from this returns table that August and September we had a severe drawdown. Over, if you compound it, it's over 35% drawdown. What happened in August of 2011? Anybody remember? Anybody old enough to remember what happened in August of 2011? Please do type on the screen if you know what happened. If you remember what happened. It's not just a accident to our fund. It's not a fat finger exercise. It's not anything to do particularly with our strategy, but something severe happened in August of 2011. That's something that is unprecedented, I might add, unprecedented. Well, some of you said it is quantitative easing. Well, quantitative easing have been going on for a while, since 2008. It didn't happen since 2009. It didn't happen in 2011. Some people said it was the 9/11 incident. No, that happened in 2001, not 2011. But indeed, one of you got it right. That was the first ever downgrade of the United States Treasury debt. It had never happened since the founding of the Republic. The US Treasury debt has been the most riskless instrument in the world. But in August 2011, I don't remember which rating agency, maybe Fitch or maybe S&P. I think it's S&P, downgraded the US Treasury debt because of a fight between Congress and the president. What else is new? So that weekend, all investment banks called back their staff on a Sunday to man the desk or prepare for catastrophe. And indeed, catastrophe struck at 5:15 p.m. Eastern time when the forex market opened, and we bore the full brunt of that kind of catastrophe. Something that has never happened in 200 more years happened just 8 months into our spotless track record. So if you're looking for a black swan event, we got it. Black swan event is supposed to be where? So what is it that we had the good luck of finding a black swan just 8 months into the operation of our fund? So here is the result in graphical format. Not a pretty sight. It's not something you want to put in your presentation for your investor. Okay, so but that is not unique to our fund. It's actually not unique. It is actually very common for mean reversion strategies. That happen when you have a mean reversion strategy. It usually delivers very consistent returns for a long time, maybe for years. Well, for us, we started trading in January and we had very consistent return for 7 months. So it is very tempting to over-leverage mean reversion strategy because they can be very consistent. You thought you're a genius. You thought you have discovered gold mine. We certainly thought we were genius in 2011, January to July. Barely a losing day. My goodness, how is the market treating us so nicely? Why didn't anyone else find these arbitrage opportunities? Only we could find it. We must be genius. Let's leverage 14 times, right? So that is the first temptation of a mean reversion strategy. But on the flip side is that things can fall apart very quickly. Any black swan event can drive it nuts and completely break it apart. And that's what we experienced in August and September of that year. The risk of a mean reversion strategy is very similar to the risk of shorting options or shorting the fixed future, except that when you are trading a mean reversion strategy, you are short realized volatility, not implied volatility. It's a little bit better. If you're short implied volatility, essentially you can just go completely crash 100% in a matter of hours. But if you're shorting realized volatility, you probably will go into a descent, less rapidly. Nevertheless, if it happened on a Sunday, 5 p.m., you will suffer this extreme gap up or gap down, depending on which side you're on, which is as bad as shorting options in many cases, especially if you are levered. Now, why is it that trading mean reversion strategy is like shorting options? A detailed mathematical analysis can be found in this textbook by Dr. Andrew Ng, Asset Management, A Systematic Approach to Factor Investing. I recommend this textbook to everybody because Dr. Ng used to be an esteemed institute professor of finance at Columbia University. He has, however, been poached by BlackRock. He's now a principal at BlackRock, so he is not available to teach anymore, but his textbook lives on forever. So there he presented a mathematical analysis of why trading mean reversion strategy is akin to shorting realized volatility. But you can think of it very intuitively. Basically mean reversion strategy is buy low and sell high. Very at the simplest level, buy low and sell, and vice versa, of course. What happened in a black swan event is that when you buy low, the black swan will move 10 standard deviation lower. So what are you going to do, right? Do you buy more? Some people do, right? Supposedly for a mean reversion strategy, when the price gets lower, you should buy more because you expect it to mean revert. So if it gets cheaper, why don't you buy more? But unfortunately, in a black swan event, the more you buy, the lower the price got. And so you essentially have unlimited downside when you trade a short mean reversion strategy, and which is very similar to shorting option or shorting implied volatility. On the other hand, on the upside, the profit is limited because in the mean reversion strategy, when your price, let's say you buy low, when the price rebound, you will exit at the profit target, right? So when it revert to the mean, that's the time for you to exit. So the upside is limited. Again, that's similar to shorting option. Shorting option, what is the maximum gain you can get? Anyone? If you're shorting an option, let's say a put, what is the maximum gain that you can earn? Yes, indeed, the put premium. You can't make more than put premium. And just like a mean reversion strategy, you cannot get more than the difference between your buy price and the mean price where you're supposed to exit, because mean reversion, right? Once it reverts the mean, you should exit. So that's the most you can get. But the downside is unlimited. The bottom can fall out of you. And that is similar to shorting a call put option. And that is also very much subject to black swan risk. So what are the methods that we can handle these kind of mean risk in a mean reversion strategy? Actually, I see that someone has asked for the book name. It's called Asset Management. Essentially, if you Google Andrew Ng, you will find his book on Amazon. I don't think he published too many books, but this is his most famous textbook. Yes, someone has commented that, one of you have commented that this is picking up nickels in the front of a bulldozer. Indeed, that is a very good way of describing mean reversion strategy. So how do we handle this kind of strategies? Well, do not over lever in good times is a good advice. Do not trust Kelly, because Kelly formula assumes Gaussian distribution of returns, and it is very difficult to apply Kelly when you know that the distribution is highly skewed, especially with a very fat left tail. So do not over lever, do not follow the recommendation of Kelly formula. Always beware of the possibility that what happened when you are sitting on the left tail of the distribution. Will it bankrupt you? will it take a 35% or 50% drawdown of your portfolio? That's the first lesson. That's easy to accomplish, actually. Just think of the worst event in history that has ever happened and stress test your portfolio based on that event. Actually, in some sense, we are fortunate to have lived through the COVID-19 crisis, because that is a great stress test for your mean reversion. If you can pass that stress test, I think you are in good shape. So the second way to deal with the risk of a mean reversion strategy is, perhaps some of you will think, stop loss, but one has to be careful here. The stop loss should be applied to a mean reversion strategy only for catastrophic loss. In other words, you should make the stop very far away from the current price, because stop loss always decreases backtest performance of mean reversion strategy. That's very easy to understand, right? As I said, if you believe that this system is mean reverting, then the lower the price, the better, the more you should get in, right? Why would you stop loss? And in fact, there is a survivorship bias at work here. Those mean reversion strategy that test well in the backtest has survived this drawdown. So naturally, if you know that this strategy survived the drawdown, you should have invested tremendous amount of money at the bottom of the valley, at the worst point of this drawdown, and you will have made tremendous money at that point, right? But what happened to those mean reversion strategy that didn't survive? When you backtest the mean reversion strategy, you would have discarded, oh, gee, this sucks, let's throw it away, right? So there's a survivorship bias in terms of collecting what mean reversion strategy you should trade. And so the strategy that you are currently trading has already survived this backtest, and there's therefore a bias there. And so a stop loss would definitely decrease the performance of that backtest, but you never know how much a stop loss would have saved you from those strategies that didn't survive. So beware of survivorship bias in backtesting, not only for backtesting stock, but in general, in backtesting strategies in general. And in this case, survivorship bias would mean that any stop loss would have decreased your backtest performance, but nevertheless, you should apply a stop loss to save you from the black swan risk that is never seen in the backtest, and in particular, that is never seen in the backtest of the survived strategy. So it is a very nuanced answer to whether you should apply stop loss to mean reversion strategy. So I think this point might be subtle for some of you. Let me see if there are any questions. There are many questions, but I think none is particularly. Oh yes, there's one about stop loss. Yeah, I think it might be too long for providing an answer for that particular one. We'll take that at the end of the workshop. Okay, so what about buying puts? Many people think that, well, to protect, to hedge, or to insure your portfolio against disaster, buying option would be the best way, right? Well, let's say we want to consider buying put option. Which put option, by the way? We are trading a forex spread, right? Are you buying a put on one side of the pair or the other side of the pair? Or because sometimes we're long one side and sometimes we are long the other. How could you be buying puts on both sides of the pair? That would be very expensive. So buying put options work in theory, but in practice, it will just waste away all the alpha or the excess return of your strategy. It is not ideal, particularly if you're trading spread, because you're basically have to buy put and call on each side. So you got to buy 4 options. That is very, very expensive for trading mean reversion trading of the spread. It's not practical. In fact, even if you have a long only portfolio, if you are buying a put option on the SPX index, that's what you get in your equity curve. This is taken from the SIBO Eureka Tail Risk Index. If you've been buying put option to hedge your long exposure, that is the cumulative P&L of your portfolio. It's just relentlessly losing. Even with 2020 first quarter, it gave you a big spike, maybe 1,000% return. It still could not make up for the losses of the last 8 years. It's incredible how expensive buying options are. So that's not the answer of hedging for hedging a tail hedge portfolio. So what can we do? Stop loss is good, but it's only for catastrophe, not really for the less, as one of you say, gray swan. And put option or option are impractical. Under levering of strategy of course works, but still, if you under leverage, your return will be lower, and then it still can get wiped out by a black swan event. So what can we do? What we can do is to run in conjunction with a mean reversion strategy, a tail hedge strategy. A tail hedge strategy is oftentimes confused with buying puts. Indeed, a lot of tail hedge funds do nothing but loading up on options, long options. One might ask, why do we need them to buy options when we could have just buy it ourselves and lose money on that, right? So why invest in a tail hedge fund that lose money most of the time? How are they better than you buying it directly? Indeed, the answer is not clear. But not all tail hedge strategies are buying options. An example would be our own tail ripper strategy that we trade in our fund. Our tail hedge strategy was up over 50% this year. That's not a surprise. It's not as impressive as some funds called Universal Capital, which was over 1,000% return, right? But over 50% return, you are pretty much okay, right? If your tail hedge strategy over 50%, it can easily compensate for any loss that you have suffered in your long portfolio if you have a proper capital allocation. But the most significant thing about our tail hedge strategy is that there wasn't a significant drawdown even during the calm market times. It has a steady rise. I mean, certainly there are drawdown. In fact, 2019 was a bad year for us. We lost about 8%, but that's nothing compared with the Spider up 30% that year. So if you're running a one-to-one allocation, you're still ahead by over 20%. I should also caution that past performance is not indicative of future results. Whatever return we obtain in the past can easily disappear in the future. So do not take this as a promise of future return. It is merely an illustration of what a tail hedge strategy can do as a form of hedging a mean reversion strategy. So the key, in other words, is diversification. We want to strive for volatility neutrality, not just market neutrality, but volatility neutrality in our portfolio. When you are running a mean reversion strategy and you want to hedge it, you are essentially hedging a shortfall strategy, a short realized volatility strategy. To hedge a short realized volatility strategy, you need to run a long fall strategy. And a trend following / momentum strategy is long realized volatility. And so they are a natural, not perfect, I shouldn't say perfect, because they don't hedge on a day-to-day basis. They only hedge on a, let's say, annualized basis. It is a very natural hedge to mean reversion strategy. So typically, we like to pair a mean reversion strategy with a trend following strategy because of the opposite return and risk characteristic. You might ask, why is a trend following strategy long volatility? There is also a very intuitive answer to that. Supposing that a naive trend following strategy is that when the SPY is up 1% that day and you go long, well, if the SPY go up further 2%, you'll be doing well, right? So you love for the strategy for the market to have a high tail risk, because any tail event means that you have entered into the right direction already, and you will ride that trend, that tail move to its conclusion at market close. And on the other hand, for a choppy market, for a very mean reverting market, a long fall strategy will lose money, because let's say the market is up 1% and you go long, and then the market mean revert by the close of the market, mean revert to 0%. Well, you just lost 1%. So a trend following strategy has the opposite characteristic to a mean reversion strategy. It is long volatility. It would like the market to move to an infinite degree in the same direction. Then it will make infinite amount of return. It doesn't like it when the market mean revert. So you are essentially long option when you're trading a trend following strategy. You are long volatility, long option. Whereas trading a mean reversion strategy, you are short option, short volatility. So combining the two strategy will make for a balance, a neutral volatility portfolio. And trading trend following strategy apparently will cost you less option premium, quote unquote option premium, than if you were just to buy put. The reason is you do not, so that's a good question. Why is it that trading a long vol trend following strategy costs less than long put option? Anyone have thought of that? Yes, indeed. One reason is you can make money from both sides. You know, you are not just betting the market will go down. You can go, if market go up, you will make money. If market go down, it's make money. So you can benefit from both sides. So that compensate for some of the losses. Okay, and the reason is, or another reason is that, and I think that's more fundamental, is that if you are buying an option, you are losing premium all the time, whether the market is open or not, whether overnight or not, whether it's a weekend or not, you're all losing options, you're losing premium. Whereas a trend following strategy does not need to trade unless it satisfies certain criteria. Certainly, you only need to trade when the market has a big moves or when the implied volatility is high. Or, in fact, we use a machine learning system to decide whether to trade our trend following strategy. You look at over 170 variables to decide whether we should trade that strategy. That is not available for a buy and hold option strategy. You are basically holding the option all the time and losing premium all the time. Whereas if you're trading a trend following strategy, you can look at many predictors to decide if you should trade it, if there's tail risk in the market that you want to hedge, right? So you have a much more flexibility when you're trading a trend following strategy. Of course, on the flip side is that there are truly unforeseen events, such as terrorism, such as earthquake, such as a natural disaster, where your trend following strategy are not trading when this happened, and the market might open a big gap. But even with this event, interestingly, the financial market is not going to absorb the shock instantaneously. There is always a period of time after the event happened that you can capitalize on. So, if there's a major earthquake in the financial center, maybe the market will gap down 20%. But that does not mean that that's the end of it. It probably will gap down to 30% by the end of the trading day. So if you are properly levering your trend following strategy, you can still capture the excess move after you enter. You do not need to capture, and that's key. A trend following strategy do not need to capture the entire tail move to hedge it. You just need to capture part of the tail move because you can adjust your leverage properly. So for example, in tail ripper, we are trading it at about 5 times the leverage of the underlying. And so we only need to trade a few hours a day in order to benefit from any tail move. You do not need to enter the market and hold it overnight. Just a few hours, because of the high leverage and because of the accuracy of the directional prediction, you will be able to hedge your tail by that kind of strategy. So that's why option premium are not lost if you're holding this strategy for such a short period. So you can see this is the cumulative return of funds since inception to today. This big drawdown is what we suffered from our Black Swan event 8 months into inception. And after that, we created the tail ripper, which is to hedge the short side, hedge the mean reversion trade. And we started a steady climb until, of course, we reap the major moves of this year, where it substantially recover any losses that we might have suffered from mean reversion trading or from a long portfolio. Okay, so let me conclude. I think we are we're ending early, which is good because there are lots of questions that we can spend time on answering. The conclusion are that mean reversion strategies profit from calm markets but can lose money severely in a crisis. But on the other hand, momentum strategy can profit from crisis but lose money in calm markets. They are exactly opposite. And combining both will create a volatility all-weather portfolio. You have heard some big fund offers an all-weather portfolio that actually did very poorly in the crisis. Well, we didn't. We create a true all-weather portfolio that did well in both crisis and prosperity. It did well in both crisis and prosperity. Isn't that what you are looking to do in a hedge fund? And with that, thank you very much again for attending. If you want to know more about us, go to our two website, qtscm.com for our investment management division, and predictnow.ai for our financial machine learning division. And thank you again. And I'm be happy to take questions. I'll pass the podium back to Aditya.
Thank you so much, Dr. Chan, for that wonderful presentation. I'm glad to see that everything and all the strategies you had really worked out remarkably for you. So, and I'm sure that our audience also got some brilliant takeaways for themselves from this presentation. So, thank you again so much. We can now take the first question for the Q&A session. So, the first question is, it's about stop loss. So, and it's asked by Tuan. He asks that I just would like to ask a kind of breakout hedging position in some point. For me, it considers as short-term stop loss, and we buy back and build our position back again until mean reverse appears. So, Dr. Chan, what would be the answer for that question?
So you have a breakout. You use stop loss as a breakout hedging, and we buy back and build our position back again until mean reversion appear. Okay. Yes, that sounds reasonable. You are essentially running a momentum strategy on top of your mean reversion strategy. So you have a breakout. So the momentum side of the strategy will enter into the opposite position of your mean reversion strategy. And then when you feel that the trend has exhausted itself, you will exit that momentum position, and effectively it allows your mean reversion position to reappear once you feel that the trend has exhausted itself, and therefore you re-enter really the mean reversion position at that point, expecting it finally to mean revert. So that makes a lot of sense. Yes, so yes, that can be considered a kind of stop loss. Essentially, you're running a breakout momentum strategy on top of the same instrument.
All right. For the second question, we have more on the setup for the strategy. So the question is asked by Harsh, and his question is, what is the setup required for this strategy to be implemented?
Let's see. The setup required for which strategy is the question. If you are talking about just a generic mean reversion strategy, it's the setup is very simple. Let's say you are trading a mean reversion strategy on SPY. I don't recommend it, but you can, right? So let's say the SPY, you are trading a buy low, sell high strategy on SPY. That's perfectly mean reverting, you might think, and it certainly had worked very well in the last few months. So you look at let's say you compute the Bollinger Band on SPY, and every time the price hit the lower band, you buy, and every time it hits the mean, you liquidate, or if you want to short, every time it hit the upper band, you short. So that would be a classic, simple, naive mean reversion strategy. the only question is SPY really mean reverting? Right? If you are guaranteed that the time series is mean reverting, the strategy to trade it is so simple, right? Bollinger Band just works just as fine as anything sophisticated. But the question is that time series truly mean reverting, or is it only mean reverting in the look back period? How do you predict the regime? That's the tricky part.
Thank you so much, Dr. Chan. Just on add on to the question, one question has been asked by Moideen is, do you need co-located servers and expensive infrastructure to trade a mean reversion strategy?
So that certainly depends on the duration of your trade, the average duration of our trade. So for example, for our Forex strategy, some of the duration can be as low as 30 seconds. And we definitely traded in a virtual private server that has a direct link to the broker's ECN. This is spot forex trading, so there's no public market. It's always organized. The market is usually organized by one or the other broker. So we have a direct link to the broker ECN, and it's not that expensive because that link is provided by a broker, not by us. We don't have to rent it; it's free. So we have reduced the latency of our signal to the arrival to under 5 milliseconds. That's sufficient for our strategy. We are not really a high frequency trader. We are, I would say, medium frequency trader. So 5 millisecond latency is good enough, and that costs no more than a couple $100 a month to get that the VPS. But if you are truly a high frequency market maker trading a truly high frequency mean reversion strategy, you might have to co-locate with the exchange, and that could, depending on what broker you use, they may allow you to co-locate with their server near the exchange or not. It can range from thousands of dollars a month to tens of thousands of dollars a month for that kind of truly high frequency strategy.
All right. Is focused towards deep learning. So Ali asks that, do you believe that deep learning methods have only limited application in financial markets?
Well, I would say that the application of deep learning is non-obvious. I wouldn't say that it's necessarily limited, but it is not going to work in the naive way that most people are going to apply it to. For example, if you are applying it to trying to predict tomorrow's price, it is likely not going to be fruitful for the reason that I keep telling people. A deep learning model typically have more than 10,000 parameters, unless you're doing high frequency trading. If you have daily data, a few thousand rows of daily data, the number of data points is far fewer than the number of parameters. It's impossible to avoid overfitting in that situation. If you are doing high frequency trading with millions of data points, yes, maybe you can succeed with deep learning. But other applications of deep learning could be quite fruitful. One example would be to use it to generate synthetic data, to learn from the past, to recreate a synthetic time series that has all the characteristics of the past, so that you can use it for backtesting your other strategy. That would be one good use. Another good use would be to identify regime of the the current market environment, to map it to a similar regime in the past. And it doesn't generate trade, it just tells you, hey, right now the market is like 1927. That could be a good use for deep learning as well, because that has much more data and it doesn't require you to actually make prediction.
All right, thank you so much, Dr. Chan. So just on that question, Aksar is asking, what is the scope of deep reinforcement learning in quantitative trading, especially looking at the real-time data?
So I think the answer partly is the same. The answer is partly the same on the previous question about the deep learning. But in terms of the reinforcement learning, I'm no expert in that. I have supervised a student's thesis in trying to apply a kind of reinforcement learning to finance. He did not find good out of sample result. I have, I'm sure that other experts are more qualified to discuss that. And I'm not saying that it doesn't work. It's just that I have not seen it work under my research umbrella.
Right. One more question that's coming up by Kumar is, in general, which method works better in stock market? Regression of time series or classification of time series?
So an interesting phenomenon is that if you're trying to use regression to predict the return of whatever the market, typically the accuracy of predicting the signs suffer. So not only does it get the magnitude wrong, it also got the sign wrong. So to me, if you find that making the correct sign prediction, like you don't want to short when the market go up, that kind of prediction, I would prefer classification.
All right. And for the bit where we discussed and we saw in your presentation about the stop loss, is it viable and advisable to have stop loss being placed according to standard deviations?
Well, I think that stop loss, as I said, is only for catastrophe insurance in a mean reversion strategy. If you place a stop loss like a small number of standard deviation from the mean, like 2% or two times or whatever, 3 times, that you are essentially going to decrease the performance of the mean reversion strategy. Because when the market is like up down to 3%, three times standard deviation, you are losing some money, but it's not a catastrophe. And you place a stop loss there, you are giving up all the large gains that is available to you. You want to put your stop loss at a pain point that you cannot tolerate. You say, I really cannot lose 20% of my asset. Okay, you can put a stop loss before that. But you don't just say that, oh, I'm going to stop loss 3 standard deviation. If 3 standard deviation does not wipe out 1/4 of your net worth and you don't mind, why stop at that point? Because it's always going to decrease the performance unless there's a catastrophe.
Yes, and this question is more focused towards the Indian markets, and it's been asked for Nifty intraday futures. But the main question here is that how can the entry, target, and stop loss be determined after market hours for Nifty future or Nifty or index futures based on daily charts? So, what do you think could be the answer to this question, Dr. Chan?
Well, instead of directly answering this question, because I don't think that it is there's a good answer to that question unless you delve into the details. One interesting point about this question one interesting question that this question triggered is that stop loss is completely useless if you are holding overnight, right? So I should have added that to the uselessness of stop loss because if you are trading a mean reversion strategy and you hold overnight and you put in a stop loss hoping to protect against catastrophe, well, catastrophe happen overnight. Your stop loss is only going to be executed when the market reopened, when it's already gapped down 10 standard deviation. So it doesn't help you at all. So that's another reason that stop loss doesn't quite work.
All right, and I hope the answer helped Rajaram with his question. We have a lot of questions coming in, and the next one is, which is the best indicator for predicting regime?
There is no one indicator that can predict regime, in my mind. Some people suggest hidden Markov model. I've tried, it doesn't work for me, maybe it work for you. The reason hidden Markov model is not easy to make work is because it only typically uses price as the input to detect regime, and that is very hard. For us, we use machine learning to predict regimes, and we use over 170 predictors. So when you ask which indicator is good for predicting regime, I would say, well, more than 170 of them in some complex, non-linear, hierarchical combination of these predictors will be able to let you predict regime.
Yes. And Dr. Chan, this question is from my end because I really wanted to ask you, and because I'm getting this opportunity to talk to you for the first time, I just wanted to know that what could be the takeaways from your brand new book that is coming on machine trading, deploying computer algorithms to conquer the markets. What can be the takeaways for learners like myself if I decide to read it?
I think the deep takeaway is kind of a refinement of the idea I had in my first book, which is that first of all, Sharpe ratio is not the be all and end all. Focus on the karma ratio. Focus on the maximum drawdown as a metric of your strategy. Sharpe ratio only works when you have a very close to normal distribution returns, and as we have seen, this is quite useless in the current environment. That's the most basic takeaways. That's why I elevate karma ratio to a pedigree, in this latest book. And the other takeaway would be pay attention to market microstructure. There are lots of successful traders. They are successful because they know the short-term behavior of the market through understanding the market microstructure. And if you want a high Sharpe ratio strategy, we're back to Sharpe ratio, but it works if you have a normal distribution. If you do want to create a normally distributed returns with a high expected mean, market microstructure might be the key.
All right, thank you so much, Dr. Chan. As we're nearing the end of the Q&A session, I just wanted to thank you for the presentation again. With this, we come to an end for our first webinar, which starts the very big celebration of the 10th year anniversary for our company, Quantitative. Dr. Chan, again, thank you so much for the presentation, and thank you for taking out time from your busy schedule for this event.
Thank you. It's my pleasure. I did. Have a great day.
Thank you. And for the audience, we are grateful to you from the bottom of our heart for showing the love and support in our journey over the years, and for joining us today in this event. I hope everyone had a very, very good time, and I'm sure Dr. Chan's presentation cannot even create a question at this point in time. So yes, for all the people who joined us from different parts of the world, I hope you have a wonderful week ahead. We'll be looking forward for you to join us in the second webinar, which will be on 22nd September, and which will be focusing upon reinforcement learning. Until then, goodbye and stay safe.